So now that we've given you a broad overview of private debt, I guess the question is, what's the rationale for private debt? Why would you want to hold it in a portfolio? So to us, the first reason for investing is always attractive risk-adjusted returns. And what we're finding with private debt is that it's possible to generate stronger returns than you would see normally in traditional lending products such as bonds. The returns are often in the form of stable and regular interest payments, which is always nice for a portfolio, especially when you're retired or about to be retired. And in some cases, the returns you're seeing here are actually quite commensurate with what you're seeing in equity investments or traditional equity investments. So that's always good. Secondly, we like to earn returns in portfolios, as we always say to you, and I think Ben actually mentioned it in his introduction, that are very different to the other returns that we're earning from other investments we hold. And private debt brings some really good diversification. These investments, while they're not risk-free, tend to act in a very different way to your traditional asset classes, such as equities or even property. And that means when you put them in your portfolio, they actually help you to lower your overall risk due to that diversification. You're also able to get exposure to different markets and geographies, which further increases your portfolio diversification. A third reason is the strong capital preservation qualities built into private debt transactions. And we're always quite careful to talk about capital preservation. The authorities tend to get quite upset with you when you mention capital preservation around investments. And we're not saying to you that you're guaranteed not to lose capital. There's always risk with investing. But tied into this, you have a very strong ability in lending to secure the loans against collateral such as property, equipment, or receivables. And depending on your loan to value ratio in the collateral, this should help to protect your capital in terms of the loans that we're making in the case of a loan default. The inclusion of covenants, which we'll talk a little bit more about later in this presentation, also gives an extra layer of protection to the portfolio. Another really interesting reason for looking at the inclusion of private debt in portfolios is the protection that it will give you against inflation. In an environment of rising inflation, the ability to structure your portfolio in floating rate loans definitely helps protect you against that inflationary environment. So what you would expect to see is as the central bank increases the cash rate, the yields delivered on floating rate loans obviously will increase at the same time. And even when your private debt portfolios are invested in fixed rate loans, which across our private debt portfolio we see a bit of a mix of the two, what you find is that these fixed rate loans will tend to roll on average just over sort of every 12, 13 months. So when they're rolling across into new loans or new opportunities, you're resetting at a higher level anyway. So you tend to move your interest rate up in that inflationary environment quite quickly. And then finally, one of the last rationales around private debt is they actually tend to be, because they're in private markets, they tend to give you very unique opportunities. Because private markets are less efficient, obviously, than public markets, or at least they should be in most instances, that'll allow the situation whereby skilled managers or lenders can come in and take advantage of a mispricing of risk and generate strong returns for ourselves.